Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. So, you know, we talked about Google. We showed a trade to the downside. We showed a trade to the upside. The official paper trade for the day, which, by the way, I always got to emphasize that these are paper trades. They're not meant to be recommendations. We're just trying to learn here on Options Guide TV. But on the Google actually announced earnings, had a really strong quarter across the board, good numbers. Stock was up about what it gave up on the day. So I definitely would have leaned to the bull side, mainly because the market was down about $6 going into the print, going into the earnings call. And then after the call, the market was up about $6. And by the time the conference call was done, the stock was flat. And then now we see the stock is down at this point in time. Now, if you remember, Google, or i.e. Alphabet, announced earnings after the close on Wednesday. And Amazon announced after the close on Friday. Out of the two underlyings, obviously with Google, doing a trade both ways with Google, a bull side and a bear side, I was a little bit more nervous about the sell-off on Google. The fact that after our Options Guide TV, the stock actually continued on down, made me lean a little bit more bullish. But right now we got Google down 8 or about 2.5%, and we got Amazon down 16 or down about 8%. So if I'm going to look at the Google trade, at the positive trade, if there's anything left on the call side, the expiration is this Friday. Well, it's Friday after the end of the day. So you would just get out, and you would have got out on, if we're doing these trades around earnings, they're around earnings. Usually by 10 or 11 o'clock, you're looking to get out of the trade, especially if it's going against you and you have something left in that trade. On the Amazon thing, there just isn't going to be much left. But let's run over to the Tradier Pro software, and I will show you the Google butterfly trade, because there is something that can be learned on this trade, in that we put this trade together. We kept our risk very low in the Google trade. We went a little bit wider in the Amazon trade, but our put butterfly we paid $2.45 for. Right now it's trading for $6. So we could get out if you did lean to the bear side on Google. And I mean, bluntly, it was a concern. The fact that the stock has gone up so much out of the Meg 7, it's been the darling over the last 6 months. And the stock had, it kind of took it away from Netflix, if you will, because Netflix decided to go out and try to buy Warner Brothers. And because of that, Google has kind of led the way. And that always, whenever you get extended over the 200-day moving average going into an earnings report, it always makes you nervous. And what I'm saying is the distance between where the stock is at and where the 200-day moving average is at, especially on these mega hyperscalers, if you will, because they always seem to try to pull them back. Even NVIDIA, whenever it got up well extended above its 200-day moving average, a lot of times you would see some type of pullback. And NVIDIA is actually up strong today. Now they're going to be announcing earnings. They're the last one of the Meg 7 that announced earnings, but it's good to see NVIDIA up 10 today, or almost 6% on the day. All right, here's the Google trade. So if you want to close it, I went in after the show and I did actually execute our trades. We did get, well, I don't want to digress, but we did close out the FedEx trade also. We got out of that position. And so now I just put in the butterflies so that we could execute it. So here it is. We're at 6 points at the midpoint. I would expect to get a net credit of $6 on the trade. We put it on for $2.45, and we were 5 points wide. So so let me get my thoughts together on this. We are right now in Google. And let's go to the options grid for Google. GOOGL. I always like to add the L. The L is the shares that have the voting rights. Just that's the only reason why. They seem to trade in tandem. But that is, you have Goog and you have Google. Okay. So we're at, right now the market is at 321.93. So we're almost right there. 321.93. If the market comes back and goes to 330, that's where our risk is at. So here, you know what? I can actually even send it to the what if calculator. So, oh, this is the closing trade. Okay, so this is the exact opposite. It's the flip graph of what we had because we're selling to close this position. But if you look at it, here's where the stock is at. If the stock was on this side of the peak, I would be more apt to stick around. The maximum you could make, you could have made, it would be 5 points on this trade if the market went on down and we ended up way down this way on the trade. Now, this isn't going to be right because it's using today's numbers. But if we went this way, we could have made $2.55. And if we came up this way, we could have made a maximum of 10. So if I'm trading between, and I do a trade like this, and I'm correct on my forecast, and I'm trading somewhere on below the 320 level, I'm okay with hanging around and trying to get the maximum on this trade, trying to get the maximum time decay. But we're on this side of the precipice. And because of that, I want to get out of the trade. You have too much potential for the stock to come back this direction by the end of the market. And if it goes beyond this nice little gain could go away and you could end up losing the $2.45. So this side I stay and I let time decay be my friend until it hits the 320 level. It goes beyond the 320 level. I want to get out. Now, this also kind of highlights the fact that this is 10 points. This whole trade here would be the long spread, the long side of this trade is worth $10. And right now we can get out for $6. So there's $4 to be had if we would land right at 320. So every hour that goes by, and we've talked about this with our discussions on zero DTE options, once you get past the noon hour, and whenever we did SPX butterflies for one day, we always wanted to get out by 1 or 2 o'clock because the market really moves as far. I think the way I like to say it is that theta or delta takes over versus theta in the last couple of hours of the day. And that delta is, gamma really kicks in, drives delta higher. And if it moves against you, it moves quickly against you, but it also moves quickly with you, right? So you can look at it either ways. But if I have a profit, I don't want things to move quickly against me. And that's why we usually get out on our zero DTE trades right around 1 o'clock or 2 o'clock. We don't really go beyond that. And I'm on Eastern time. So 4 o'clock is when the market closes. All right. So 650 now. That shows you the amount of time decay right now. Okay, so let's do it for 6. I'm going to close this out, capture that profit. Remember, I'm in the paper trading account, so it's going to be hard to fill at the midpoint. If this was a real account, I would try to get that 640. I'm going to send it at 6. So net credit $6, closing our butterfly. Boom, order is sent to the floor. Yeah, now I'm having problems sending it. All right, 1 second. Let's see what's going on. We are froze a little bit. Oh, it says the order is successfully sent, but I didn't get the ding. Looks like we're froze a little bit. Oh, there it is. Boom. Boom goes the dynamite. Okay, now we need to get back. Come on. Next thing that we're going to look at doing then is we'll just look at Amazon. Amazon's not the trade. There's nothing going to be left. I guess I'll just show it, and I'll say that if we did the wider trade on Amazon, we still got it done for, volatilities were higher. There we go. We moved. You can show it in the corner if you want. That's where my order is at. Filled with 4. Okay, so we actually filled that trade. Yeah. The Uber trade number filled, but that's fine. Short butterfly net credit. Yeah, we got that trade off for a limit of $6 to the account on the put butterfly side of things. All right. So looking at the other positions, the FedEx position is gone. This is going to expire worthless today. There, you can see right now that the options are all 1 cent. JP Morgan, real strong move in JP Morgan recently. 320. Where are we at? We got to roll that one too. We need to take this option contract. We got to roll this position today. We don't have a choice. So let's roll. We had 2 covered call positions, and the FedEx trade got pegged because FedEx went ballistic from Monday to Wednesday, and that didn't give us an opportunity to place that trade. Okay, so here we are down here at the bottom. We are buying to close the 320 with the 13th expiration, which is next week, and we're going to sell to open the 20th expiration. We're going to go, let's look at 320. Where are we at on JPM? 322 right now. Let's see where 325 gets us. Net debit of that. So we're going to go out to 306. Net credit of $2. See what happens if we get to 330, 25 cents. Man, it would be really nice if they had a 327.5, but we're looking at 325, net credit of 2. Yeah, we'll do this. We'll just do this right here. We could come back. Let's look at 27, see how much. That's 68-cent net credit on 27, gives us 1 less week. Yeah, I really wish we could go to the 327.5. Okay, so here's what I'm going to do. Let's do the 227 expiration for net credit of 60 cents. Then that gives us a little bit of flexibility. If we had a 327.5 strike, I would look to roll to the 327.5. But all that it's offering us is the 325 and the 330. So because of that, I'm going to go shorter, bring in a little bit less of a credit. Hope that it expires worthless. We're going to bring in a net credit of 60 cents. As I've said many times on these trades, you don't want these to get in the money. We're a smidge in the money. On a $320 stock, we're 2 points in the money. We don't want to be 5 points in the money. And so the risk of being assigned is much scarier than the risk of we just don't want to be assigned because we don't own the underlying stock. So I'm always going to roll early when it comes to fig leaves, where you are long a deep in the money call option and you are short a shorter term option against it. So here's our roll. We're buying to close the 320 with the 13th expiration, selling to open the 325 with the 27th expiration. Net credit right now, it says 40 cents. We just want to get it off for a net credit period. So we'll leave it at 40. 48's right there. That might fill inside the paper trading app. All right. Order is sent to the floor. Now, I'm going to take this opportunity because I still like Google and I still like what we heard from Google. And I'm going to take this as an opportunity to add Google to our portfolio. We don't have a ton. We have a Netflix, which is, Netflix is going to meander around. I like Netflix, but I don't, in my own account, I would rather own the stock in Netflix than the options. We have the deep in the money call option, and the Warner Brothers thing is getting muddled, and who knows when it's all going to flush out. When it does flush out, I want to be long Netflix, because I do think, once again, it will become a darling of the market. It's always traded at a premium. It was doing extremely well until it tried to get in the middle of this. But if they do end up with Warner Brothers, that's a good thing for the company. It diversifies, allows them to get it more into sports. It allows a lot of things. I think it would be a good thing just in general for the competition. They're starting to say, well, then they're going to be a leader in streaming and all this, but there is so much competition out there in this space, and there always will be, it seems. So you have plenty of other, the only reason why they, in my opinion, that they would not allow the merger to go through is because for some reason they didn't want Netflix to own it. That's the only way that I can look at it, that I can see it. All right. So we got the Netflix, we got that, JP Morgan, Google. Let's go in and buy our Google trade. Okay, so let's go out. We're going to go beyond June, and we're going to put that position in our paper trading portfolio. So we'll go March, April, June. We'll go to either July or August. Okay, so, when you get out to these further months, by the way, it's not always apparent that they're going to be available. But when the expiration comes closer, obviously the weekly parameters of trading options will open those expirations. But when you go out half a year or beyond, the month that you want to trade might not be there. So I'm happy to see all of our other positions got the June expiration on, but we have July and we have August. August is 196 days, so it's over a little bit more than a year. Let's see how much that option is. If we go to the August 21st and we get to the 80, we're looking at $6,000 on $32,185. Okay, so 6,000, and I just want to see, I want it to be somewhere around 15% divided by 32,174 equals 18%. All right, so we're close. We're a little bit more than 18%. Yeah, let's do July. It's going to be too pricey to do August. Let's look at the 80 in July. 80 delta is 6,000 on the head. We'll do, this is the 79 delta, 16 delta. This is it. This is our option contract. Okay, here's our paper trade for the day. Instead of buying 100 shares of Google, we are going to buy one Google 280 strike call with a 79 delta. So it acts like 79 shares of stock. And I clicked 2, of course. Clicked on it twice. And we got it at 58. Now, once again, I'm going to have to give up more than I want because this is a paper trading app. So we're going to go 655. 655. Let's 58, 55. Okay, nice. We moved. Let's go 58. 58. Let's see if we can get it at our 58 where we first came in at. Boom. Order is sent to the floor, and I do love this about the Tradier Pro. If you ever have an order inside a chain, it highlights that order is in there. It also highlights if you have a position. So right now, it's making this green, showing that you have a buy order in on this long call option. And then if you go to the orders tab, here it is showing you that we have that order. All right. So if we have any, and good morning to you, Kurt. I see that, but we're almost at time. It's 11:20 right now. Do you have any questions on the positions? If you did go bearish on the Google trade, I would get out of it. As long as the stock is not below 320. You take the trade and you put the position on. I probably would have got out of the trade yesterday, honestly. But we're looking at it right here. If you went on either side of the trade, if you took the bull side on Amazon or you took the bull side on Google, there's not much left. You might go in right on the open and try to close them afterwards after the market is down, but that's just the way to approach it. To start with, I thought Google was going to that trade was going to look perfect on the call side because we opened exactly the amount that it was down on the day after the earnings amount. After the earnings report, we opened the exact amount that it was down on the day. Looked like momentum was strong to the upside, and then it just totally reversed after the conference call. So there we are. Okay, so we're going to come back on Monday. I don't see any other questions that are out there. That is live. It's streaming. Let people know. We're out here. Tradier has made it available to you to come out and have access to a plethora of great speakers inside their Tradier hub and also on their YouTube channel and many other different locations. All the social media traders got it up and running. So if you'd like to follow us, please let us know. Click subscribe, ring the bell, and we'll see you this Monday at 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.